Is my screen visible to all of you?
Yes, sir.
Yeah. Okay. Thank you. Thank you. Good afternoon, everyone, and welcome to this revision session for corporate finance for towards the final quiz. And agenda for today is that we will revise the concepts of week 9 to week 12 and take some important questions from the GAs and the PS, and thereafter we will solve the PYQ which is available. So with that, I shall start. Okay, so we come to the important concepts of first week 9. So week 9 was about, if you recollect, it was about all the exchange rates. And here some important points are like that. When we take the exchange rate is equal to 80, for example, Indian rupee, $1 is equal to 80 rupees. So the convention is that we write E is equal to 1 by 80. So please remember this for the calculation parts. I will share this document also after the session. So there are certain important formulas from week 9. The first formula is real exchange rate. So real exchange rate is denoted by this small epsilon, and this is equal to E into P divided by P star. So E is your exchange rate in this convention, which I have written. P is the price which is domestic. For example, if you are taking India, then this is the price in India, and the P star, which is the price in a foreign country. So in this case, again, in dollars in USA. So by using this formula, we can come to know the real exchange rate. Now, second important formula is the interest parity condition, and it says that 1 plus IT is the interest rate in your domestic country, is equal to ET is the exchange rate, into 1 plus I star T, I star is your interest rate in the foreign country. So by using this, if they give you other variables and to find one variable, we can easily find this. And divided by ET plus 1. This is the futuristic exchange rate. So this is the complete formula. Now you can also write this formula as this. And this I have given that 1 plus IT is equal to 1 plus IT star divided by 1 plus delta E, where delta E is nothing but ET plus 1 minus ET divided by ET. So this formula is easy to remember. We can remember this and solve this. Now, if we are asked to give the rough estimate, then the rough estimate is IT is roughly close to IT star minus delta E, but it will not give you the correct estimate. It is only the rough estimate. Okay, so we have seen three important formulas. Epsilon is equal to EP by P star. Then interest parity condition 1 plus IT is equal to 1 plus IT star divided by 1 plus delta E, and the rough estimate. Now there is another formula which is about the real uh, return rate, which is 1 plus RT is equal to 1 plus IT plus 1 plus pi, where pi is the inflation rate. This is from week 5 to week 6. Now if we use this in this formula, then we get 1 plus RT divided by 1 plus RT star is equal to PT star plus 1 divided by PT star into PT by PT plus 1 into ET by ET plus 1. And if we put these values into the real exchange rate, then we arrive this formula. So this is another important formula. So we get real exchange rate is equal to 1 plus return in the domestic country, 1 plus RT star, which is the return in foreign country, into real return rate ET plus 1. Now, there were some questions in the GAs in which directly they had asked about the GDP deflator, though this term was not covered in the lectures. So the formula for this is the real exchange rate is equal to GDP deflator in your own country divided by GDP deflator in a foreign country into normal exchange rate. So normal exchange rate is E. Okay. So with this, I have covered the important concepts. Any question till now? Anybody's mind? Okay.
Yeah, you said that one is rough estimate that
Yes.
IT. When to use when?
If okay, they are asking you to give the rough estimate, though I have not seen any question in the GAs in the PYQs where they have asked the rough estimate. However, if they ask you, so just hold on. So the important formulas again I will write okay, from week 9. First, okay, we take E is equal to 1 by 80. Remember this. 1. Second is real exchange rate is equal to EP divided by P star. P is price domestic and P star is price foreign. Now another formula is 1 plus IT is equal to 1 plus IT star divided by 1 plus delta E, where delta E is equal to ET plus 1 minus ET divided by PT. Okay, and another was about your last one. Last formula was real exchange rate is equal to, also can be written as the real exchange rate is also can be written as GDP deflator divided by GDP deflator star into E. So these are the important formulas. And you asked about the rough estimate. So rough estimate says E is equal to IT minus IT star minus delta E. So this is the rough estimate. Okay, all these 5 formulas are clear?
Okay.
Okay. Okay, so we take some questions where they had asked. Okay, I hope my screen is clearly visible to all of you. Or shall I zoom in slightly? Okay, so a question was a Chinese yuan buys 10 Indian rupees. The GDP deflator is in India is 110. GDP deflator in China is 105. So what is the real INR to CNY exchange rate? So here all the concepts will come. First of all, we have to calculate the exchange rate, that is E. Real here, sorry, small e. So small e is equal to E into P divided by P star. So here they have given 1 Chinese yuan buys 10 Indian rupees. So we can write that our E will become 1 by 10. And your P deflator, GDP deflator is 110 and Chinese is 105. So using this, okay, we get the answer 0.10476. And if you want to convert it into something like 1 by 10 or 1 by 80, you can do simply as 1 over 1050 divided by 110. So this term will give you the real exchange rate. Now we come to the next question. An investor is indifferent between purchasing US government bonds and Indian government bonds. US government pays a 4% rate of return in 1 year, whereas Indian government bond pays an 8% rate. The current USD to INR is 80. So what is the expected USD to INR exchange rate? So we use the formula 1 plus IT is equal to 1 plus IT star divided by 1 plus delta E. So from here we will get 1 plus IT divided by 1 plus IT star. This term is equal to 1 plus delta E, and we get delta is equal to minus 0.037. This will become minus 0.037, and now using this into ET plus 1 formula we can get the ET. Is this clear again, this question, or shall I solve it slowly? Ullas?
Yes, sir. Yes.
Yeah, okay.
No, this ET plus 1, can you just explain how to?
Okay. Okay, just hold on. So this was the question. So we use the formula 1 plus IT is equal to 1 plus IT star divided by 1 plus delta E. So from here we get 1 plus delta E is equal to 1 plus IT star divided by 1 plus IT. Now IT star is US, so this is 0.04, so this will become 1.04 divided by 1.08. Okay, therefore delta E is equal to 1.04 divided by 1.08 minus 1, and we can see it will be something negative because this term is less than 1. Now finding this delta E, we know that delta is nothing is equal to ET plus 1 minus ET divided by ET. And current exchange rate here, they have given it is 1 by 80. So this will become ET plus 1 minus 1 by 80 divided by 1 by 80. Equate with this okay, delta E, the value which you have got, and you can get okay, ET plus 1.
Okay. Okay.
Is okay? Okay. Now we come to the next one. The nominal exchange rate of INR euro is 100 INR per euro. A basket of fruit costs 500 INR in India, whereas it costs 6 euro in euro. So exchange rate, like we write 1 by 100. So in India, if we convert the rate to euro, so 500 will correspond to 500 into 1 by 100 is 5 euro. Whereas this basket is available in euro for 6 euro. So therefore in Europe it is costlier and India it is cheaper. They had asked this. The next question is the same again, the which we solved earlier. The prevailing interest rate in Japan is 2%, China is 6%. What is the expected rate of appreciation of Japan to Chinese exchange rate? So here they're asking they basically delta E. So this is the expected rate of appreciation. So we straight away fit this formula and we get the value of delta E. Is this okay? This one?
How do we decide which is the domestic country, which is the foreign country?
Okay, so here they are asking Japan to China. Okay, and if we recollect, our was India to US. So we used to take 1 by 80. So here we will take Japan to China means 1 by, what is the exchange rate of 1 Chinese to how many Japanese currency we can get? Is that okay? So here I have written E Japan to Chinese. So this will be 1 by X, okay, 1 Chinese and how many Japanese we are getting. And in this question, they are not asking anything, they are asking just delta E. So here we are taking Japan, here we are taking China, and this delta E comes. Okay, so this is the important part, okay, Japan to China. This is the important part which we have to look for. Is that okay?
Yes, it's clear. Thank
you. Okay, now we come to next question. The real rate of return in US is 2%, in China is 5%. The current USD to Chinese exchange rate is 8 Chinese per USD. The GDP deflator in US is 108, expected to rise to 112 next year. GDP deflator in China is 128, 120, which is expected to rise to 125 next year. So first they have asked what are the nominal rates of return in US and China respectively. So nominal rate, we know the formula that 1 plus RT is equal to 1 plus IT divided by 1 plus pi. This is the from week 5 to week 6. Is this okay, this formula?
Yeah.
So from here, if we expand it to get to IT will become 1 plus pi into 1 plus RT minus 1. So use this formula to get the nominal exchange rate because they're asking the nominal rate and they have given the real rates. So for US, it will become 1 plus pi and into 1 plus RT. So RT is 2%, so it becomes 1.02. And we have to know this. Now we have to calculate the inflation rate. So inflation rate they have given that in US it is expected to rise to 112. Present is 108. So your pi USA will become 112 minus 108 divided by 108. So this is the value of pi. So you put again this value minus 1. So we get the rate, nominal rate existing for USA. Same thing we do for China and we get the answer. Is this okay? Any confusion in this?
Clear.
Clear. Okay. Clear. Okay. Now we come to that. What is the expected nominal rate? So expected nominal rate, okay, we know that 1 plus IT is equal to 1 plus IT star divided by 1 plus delta E. So IT star already we have got from the previous question, which was 0.0577. And this is USD to China. So from here we get 1 plus delta E value, which comes delta E we get 0.034. And now putting this delta E into the formula of ET plus 1, we get the expected nominal rate, okay, which is ET plus 1. Is this okay? This one, this question, this was in the continuation, or shall I solve it again? Okay, I'll solve this question in detail because I feel that there are certain important concepts in this question and we solve this. I request all of you, you can open your GA page to see this question. So there are two parts to this question. In fact, there are four parts. Solve them one by one. Is this visible to all of you, the questions?
Yes, sir.
Okay, so what are the important things which they have given? They have given the real rate of USA. The R USA is 0.02. R in China is equal to 0.05. The current USD to Chinese exchange rate is 8 CNY. It means if we consider from China to USA, then it is 1 by 8 exchange rate of China per USD. The GDP deflator in the US is 108. So GDP deflator presently, USA is 108. And it is likely to become GDP deflator USA to 112. For China, GDP, China is given as 120 and likely to become China is equal to 125. So these are the four questions we have to solve. First, they are asking what are the nominal rates of return in the US and China respectively. So we know that they have given the real rates and they have given also the exchange, okay, EC is equal to 1 by 8. So we have to find the nominal rates of return in US and China. So nominal rates of return, we find the formula 1 plus RT is equal to 1 plus IT divided by 1 plus pi. This is the formula for the real rate and the nominal rate. So from here, we can get nominal rate is equal to 1 plus pi into 1 plus our real rate minus 1. Is this okay? Till now? And this is
Yes.
This is common to both the countries. So now we have to find, now we are given R value we have given, but pi we have to calculate. So pi for USA will become 112 minus 108 divided by 108. For China, pi China will become 125 minus 120 by 140. Now we have got everything. So we can get the nominal rate for USA is equal to 1 plus R, that is 1.02. Now this value we have got. Can somebody calculate this? 4 by 108? Quickly. So this becomes 4 divided by 108 is equal to this, and this will become 1.037 minus 1. So this will be the nominal rate for USA. For nominal rate for China will be 1.05 into 125. This will come 5 by 120. And this will become 1.041. So here we have got the answer for the nominal rates. So here we have got the nominal rates. Now we come to the second part of the question. What is the expected nominal rate of the to China exchange rate next year? So expected nominal rate is, what is the formula? We get from 1 plus IT is equal to 1 plus IT star divided by 1 plus delta E. So this is the Chinese nominal rate present, which we have got from here. This is the USA rate, okay, which we have got from here. And from here, we will get to know the value of delta E. So once you get the value of delta E, we just put it to 80 plus 1 minus ET divided by ET. And present ET is the rate which they have given is 1 by 8. Okay, USD to Chinese exchange rate is 8 China. So here you put ET is equal to 1 by 8 and you will get the ET plus 1. Is this okay?
Yeah.
Okay. So sequentially they have asked the question. So this we have got expected. What is the current real USD to Chinese exchange rate? So what is the current real USD to Chinese exchange rate? So what is the formula for real rate is? Real is equal to 1 plus R is equal to, or R is GDP deflator own and GDP deflator USA into present 1 by 8. Is this okay? This formula is okay. R is equal to GDP deflator domestic, GDP deflator foreign into E. This we had seen it in this formula. And then they have asked, the last part is, what is the expected real USD to Chinese rate? So in that only the expected will become RE is equal to the future GDP deflator China divided by GDP deflator USA into 1 by 8. Is this okay?
Yeah, sir, it's clear.
Okay, good. So now again, okay, we can see the week 9 basics, okay, basic formulas. Just to revise, 1 plus IT is equal to 1 plus IT star divided by 1 plus delta E. Delta E is equal to ET plus 1 minus ET by ET. 1 plus RT is equal to 1 plus IT plus 1 plus pi. This is for the inflation. For inflation, so here you get the real exchange rate. Then real exchange rate is also EP by P star. And RT is equal to nominal rate into GDP deflator own divided by GDP deflator of foreign. And this is a rough estimate we have seen. Okay, so can we go to week 11? Week 10 and 11? Any confusion about week 9? Anybody? Any questions?
Yes, sir. One question.
Yeah.
In the key formula 3, E is equal to EP by P star.
Yes.
right?
Yes.
Now here, the P is the domestic and P star is the foreign.
Yes.
And this I am calculating from domestic to foreign exchange rate, right?
Yes.
Now, sir, if you just go up, just now you solved the USA China,
Huh.
that part.
Yes.
Just hold on, sir. This 1/8 is US to China or China to US?
This is see, $1 is equal to 8 China.
That means US to China.
When we write exchange rate, like I said, in initial conventionally, we write 1/8. So this we are calculating, for example, for China. So here the China rate will come. Here US
So
rate will
this
come.
1/8 is equal to basically $1 to Chinese.
Yes.
Correct, correct. Okay, okay. So
Okay.
clear.
Yeah. Okay, we will see some questions in the PYQ also. So these are the important questions from the GAs. Anybody, any question till now? So again, just to revise, when we say Indian exchange rate, INR exchange rate is $1 is equal to 80 rupees. And then they say price of, for example, petrol in India is 80. Price of petrol in USA is, for example, $2. Find the real exchange rate. So real exchange rate will become epsilon is equal to 80 by 2 into 1 by 80. So epsilon is equal to 1 by 2. So real exchange rate in this case will become $1 is equal to 2 rupees. Is this okay?
Yes. Okay.
Okay. Okay, so week 10 and 11, they had similar concepts. So I will quickly cover both the these week 10 and week 11. So before that, I will just cover certain basics of the call, port, what is all this business, what they have covered. Okay, so I will just cover something that today, for example, there is a share which value is 100 rupees. So if you have operated in the share market, this is, for example, this is some company ABC. Its share is for 100 rupees today. Now, I can purchase the call option. I say I will purchase the call option, for example, some rupees X with a rider that if this share increases to 110, so anything above 110 will be my profit. And if it is less than 110, then I get 0. So this is a call. Is this okay? The call understanding?
Yeah.
Okay. So for example, now this share has reached 120. So what will be the profit?
10 rupees.
10 rupees.
10 rupees. And anything which is below 110, I get 0. And now, for example, if I had purchased this for 5 rupees, so what will be my net profit?
5 rupees.
5 rupees. Now, this is when I buy a call option. I also can sell a call option. I can say that in the sell, I don't have to pay anything, but I say I put a strike rate. So this is known as strike rate, excise price. This is stock price. So this is also written as S0. This is also written as X. So make it a small x. Okay. Now I can also sell a call option, and I say that if I sell, for example, one call option, I sell. And I say that anything which is above 110, so I will pay this amount. If it is less than 110, I pay 0. So this is selling a call option. Is this okay? So here I make profit only when, so when I sell the call option, so some people they will purchase. So for example, one person has purchased for rupees 5. So I get 5 rupees here. And if it is less than 110, I don't pay anything. So my profit is 5 rupees. If it has gone to, for example, 120, then I pay 10 rupees and then my net profit is how much? -5.
-5.
Okay. So this is about call. Then we come to put. Put is just opposite of this. So put is, there is a share of 100 rupees. I buy a put for rupees 5 and I say excise rate is 110. I will get only money if it goes less than 110. If it is more than 110, I get 0. And whatever is the below 110, I will get. So for example, it goes to rupees 90. So I will get rupees 10. I had paid -5. So my net is how much? 10 minus 5 is equal to 5. Is this okay?
Yeah.
Okay. And similarly, I can sell like a put option. So when I sell, for example, two put options, one put option for rupees 5. So I get rupees 5 and excise rate is 110. And I will pay only when the share is below 110. So for example, it has gone to 90. So I have to pay 10. So my net profit is how much?
-5.
-5. Is this clear to everybody? What is call or what is put?
Sir, in this buying put option here,
Yes.
strike price is 110, right?
Yes, strike price is 110.
And it goes to 90.
If it is goes to 90, then I get 10 rupees. Oh, sorry, 20.
Yeah, 20 rupees. Yeah, right.
20. Sorry.
Okay, sir. Clear.
Okay.
Yeah.
Now with this, okay, now we will cover certain how these prices are calculated. Okay, so I have covered already. S0 is the present value call price. Okay, this I have covered. Okay, something intrinsic value theory I will not cover. Okay. So there are this 5 rupees which we are saying. This is known as call premium. That how much you have to pay. So there is a lower bound, and that the call premium has to be always less than the current share price. Okay. And it is always more than, call price is always more than S0 minus X divided by 1 plus RFT, which is the real interest rate, risk-free interest rate. Okay. So from here you get the formula. If I call this call premium as C0, then the C0 is equal to S0 minus X divided by 1 plus risk-free rate into T. This is the first formula. And if it is a continuously compounded interest, then this part which is there, we have to write as C0 is equal to S0 minus X e to power minus RT. Is this okay? These two formulas are okay? Understood?
Yeah.
Okay. Now, third formula is known as call put parity. That call, if the call is increasing, the put will decrease. If call is increasing, call is decreasing, put will increase. And their call parity ratio is given by this formula. C0 plus X to power minus RT is equal to S0 plus P0. So here it is considered continuously compounded. Otherwise, you can use this formula also. Is this okay? Now I'll cover certain steps, okay, how you calculate the call price or the call premium if you have been given. So I will cover it in a short way. Okay, just not take so much of time. So, for example, we have been given that the share price is 100. This is the call price C0, which I don't know, which I have to calculate. There are two scenarios they have given. This is for call. That either the share can go and the excess rate is 110. There are two scenarios. Either the share can go to 120 or the share can go to 90. So what do? We first found the hedge ratio. Hedge ratio is nothing but what is the profit if I call profit divided by, or we can say delta C over delta S. Delta S is the stock price. So in this case, you see here, I will get a profit of how much? 120 minus 110, 10 rupees. And this is 0. So my hedge ratio becomes 10 minus 0 divided by 120 minus 90. This is 1 by 3. And what is the meaning of this hedge ratio? The meaning of this hedge ratio is that for every call option, I have to hedge 1 by 3 share. Means that if I have to remain risk-free, then for every call option which I make, I have to hedge. Hedge means I have to keep 1 by 3 share. Now to keep this 1 by 3 share, how much I have to spend will be 100 by 3, 33.33. Okay. So my present portfolio, if I purchased this share for 33.33, then my present becomes 33.33 minus C. Is this understood? Jalaj?
No, sir. I mean, how does minus C come here?
Because here I have to purchase that call option. No? So I have to spend that C amount.
Okay.
Okay. So here I have purchased 1 by 3 share, which I got from here. For this, I have to spend 33.33 rupees. And then I will purchase that. So I'll spend something C. So this is my present value. Now this value, now see the future value in both the cases. Now take scenario where the share has gone to 120. Now to purchase this share 33.33, I will have to take this money on loan from somewhere. I don't have anything.
Yes.
Okay. Now in this case of 120, when it goes to 120, so I make a profit of 10 rupees. And what is my share value this time? Okay, and I will return this loan which I have taken.
Okay.
So I will get some amount, and this amount I can directly calculate from this scenario 90. In the scenario 90, I don't make any profit. I'm remaining with how much money? 90. The share value is 90, and how much share I have got? Only 1 by 3. So I have got only how much? Rupees 30.
Correct.
Now this rupees 30 is in the future after T. So what is the present value of 30? Present value of 30 will be equal to 30 divided by 1 plus R into T. If T is equal to 1, then it becomes, and R is equal to, for example, 10%. So this will become R 30 divided by 1.1.
Yes. In a scenario where we are making a loss.
We are calculating in both, and in both the scenarios, your value will come 30 only. If you're making risk-free.
Okay, right.
Okay. Now this value which is there, you equate now with this 30 over 1.1 will be equal to 33.33 minus C.
Yes.
And from here you get the C value 33.33 minus 30 divided by 1.1. How much it will become? 11. 128, 20, something, some value will come. You can calculate. And this is the your call premium price. Are all these steps clear to you? Or we will solve some questions on this concept.
Just sir, can you explain just why you are minus this 33 point from 33.33 to C?
See, scenario is like that. I will cover again.
This will be our risk-free return, right?
This is the risk-free return. This is your risk-free return. I will cover again. Okay, so I will cover from starting. There is a share, the value of is 100 rupees. After certain time t, I want to purchase some call option. If I purchase some call option, so I have to purchase that for value minus c. And I say that there are two scenarios. The strike rate is 110. Either this can go to 120 or it can go to 90. So if it goes to 120, my profit is 10. And if it goes to 90, profit is 0. So from this, the first step, just give me a minute, okay? Hi, sorry, I had received the call. Am I audible now?
Yeah, sir, you are audible.
Okay. So the first step, so this is the scenario which has been given, and we have to find the call premium. Okay. This is S0, this is X, and rate is also given. Rate, risk-free rate is given 10%. Okay. Now, first case there is to find the hedge ratio. Step 1, find hedge ratio, which is equal to delta C. I will write delta CP, the profit from the call, divided by delta S, which is the stock price change. So from here we get, this will become 10 minus 0 over 120 minus 90 is equal to 1 by 3. And the meaning of this is that, for every call option, keep 1 by 3 share. Okay. Now, when I keep this 1 by 3 share, it means I have to purchase 1 by 3 share. So value of 1 by 3 share is equal to 100 by 3 is equal to 33.33. Is that okay?
Yeah.
Okay. Now, step 2. So from here, if I have purchased a share of 1 by 3, so my present value is how much? 33.33 minus C. Is this okay? My portfolio value is this. Now I equate, instead of both the scenarios, just calculate the portfolio value in the zero scenario. So in the zero scenario, your how much you will be having, the share is become 90 and you have got 1/3 share. So you are remaining with how much value? 30 rupees. You convert this to present value, will become 30 by 1.1. Now, for risk-free, your values should remain same in all the states. Therefore, 33.33 minus C is equal to 30 divided by 1.1. Is that
Yes.
okay? So from here, okay, you will get the value of C. Okay.
Okay.
Yeah.
So why just you are taking the zero scenario to equate this?
Because risk-free state means that I should not suffer any loss occur. In all the scenarios, I remain with the same value.
Oh, okay. 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 Clear.
Okay. Okay. We will see some questions also on this. Okay. So this is all theory which is there. Hedge ratio I have covered. Okay. So we will see the questions again. Now there are certain strategies they were covered: straddle, strip, strap. So straddle means that when you buy both call and put options, you have purchased one call option also for the same strike rate from the same share, and you have also purchased one put option also. So whenever you are having a straddle, you will never face any loss. It means you will always be non-negative. But in the market, okay, when you go for this, so then you will find that call and put option, both the prices are same. So you remain with zero only. And if you're lucky, then you can make some money. Strip means strip, just to remember that first is call and then is put. So strip means strip. So you put 2 and 2 and strip the call. So strip the call by 1. So strip means call is 1, put is 2. And strap is opposite. That call is 2 and put is 1. Is that okay?
Okay.
Okay. Now, there are certain other formulas also in this. So this was the first approach which I covered to calculate the call price. So this what I covered. So there are many approaches to calculate the call price. So first is using the hedge ratio. So this was using the hedge ratio. Using hedge ratio. You find the call. Calculate call premium. The second method is also using probability. That what is the probability of making profit and what is making of having loss. So remember, the price of any option does not depend on the risk, how much you are taking. So whatever the strategy you apply, you will get the same answer. But we have to remember the formula in case they ask us. So formula for risk neutral probability is P is equal to 1 plus RF minus D divided by U minus D. And how this has come, just we know that call option is equal to expected CF. So this is expected portfolio, how much I will earn, divided by the risk rate. And we also know that in case the probability of winning is P, then of 0 will be minus P, and this U and D are nothing. U is 120 by 100 in our case, and D is equal to 90 by 100. So these are the values of U and D. And if you put this, you get the formula for the probability. So the probability, risk neutral probability is 1 plus rate, risk-free rate, minus D divided by U minus D. So from here you get the probability. But if you use this formula also to calculate C, you will get the same answer, which we got again from the hedge ratio also. So the main takeaway is that the risk preferences which are there, they cannot alter the call prices. Okay. Now we come to certain other formulas So we found that probability was 1 plus RF minus D divided by U minus D. So this formula is for the price. So this is for the price. If you put this into the probability, so price will become e to power R delta T minus D divided by U minus D. Delta T is nothing, total time divided by time periods. How many time periods are there? So in case they say 1 year and there are 4 time periods, so this will become 1 by 4. Second formula is for U and D. U is e to power sigma delta T, where sigma is the standard deviation, and D is the minus of sigma delta T. So delta T remains same, and this is the standard deviation. And stock price, this is the third procedure, third process. The stock price will become S0 into UN into DN minus K. Then there is a Black-Scholes formula. So I had asked in
What is N here?
what again?
N.
N is the number of time periods.
Okay.
Number of time periods. So if you take this, this is nothing but it is a binomial formula. So this is the U3 binomial. Then there is a Black-Scholes formula. So I had checked in the G space that we cannot remember these long formulas. So the instructor has clarified that we will not be asked on the base of this. We don't have to remember the formula. Okay. Just we remember some things. Okay. So in one of the PYQ they had asked. So just for the sake of completion, I will cover. As per the Black-Scholes formula, your call option price is equal to S0 into ND1. This ND1 is nothing. It is the normal distribution value as for the D1 minus x to power E minus RT into ND2. This is also normal distribution of this. And how do we calculate D1, D2 or as per this formula? And in this formula, this ND1 which is there, this is the hedge ratio. ND1 is the hedge ratio for the call. And if it is a put, then ND minus 1 will be the hedge ratio. So just remember this. That if they give you the formula and they give you value, then what will be the hedge ratio? So straight away ND1 is the hedge ratio for the call, and ND1 minus 1 is the for the put. So with this, can we go to the GAs again of week 10 and 11?
Yeah, okay.
Yeah. Okay. So, or otherwise, okay, we can see some formulas, also important formulas. I will just take you from there. Okay. So we have seen hedge ratio formula, delta C by delta S. Okay. And so this I have covered how to calculate C0. Then this is a very, very important formula. Remember this. This is the call parity. This is the call put parity. C0 plus X e to power minus RT is equal to S0 plus P0. Then there is a risk-free, this probability, risk-neutral probability. Remember this formula. 1 plus RF minus D divided by U minus D. And then this is these are three formulas. This is for the price, e to power R delta T minus D, U minus D, and U and D when the standard deviation is given. Okay. So now we come to this question. The price of a stock is 67. The trader sells 5 put options. So he's selling contracts on the stock, with a strike price of ₹70 when the option price is ₹4. The options are exercised when the stock price is ₹69. What is the trader's net profit or loss? One option contract is equal to 100. So I will just copy this and understand this question. So see, the price of the stock is presently 67. The trader sells put option. So when he sells the put option, he will get money. Somebody will purchase, and the strike rate is 70. He has purchased, sells 5 put option contracts. One option is 100 options. So it means he has sold 500 options for 4. So he has got rupees how much? 2000. Is this okay? Calculation of this 2000?
Yep.
Okay. And now the stock price has reached 69. The options are exercised. So how much okay, he has to pay now? Only rupees 1 rupee per option. And how much he has sold? He has sold 500. So 500 into 1 is equal to 500. Therefore, his profit is how much? He has to pay minus this will become 2000 minus 500, 1500. Is this okay?
Yep.
Okay. Now, if I ask you the same question, and if I tell you that instead of selling, he had purchased this account. So if he has purchased, then what will happen? So if he has bought, it means he is paying how much? 500 into 4, 2000 rupees. And he will get only 500 rupees. So in that case, okay, his profit will be minus 2000 plus 500. Okay. Is this understanding clear? Any confusion in call and put?
No, it's okay.
Okay. So now with the same, then things become very easy. Suppose the price of a share of a Reliance stock is 500 now. A call option on Reliance stock has a premium of rupees 5 and an exercise price of rupees 500. Ignoring commissions, the holder of the call option will realize the profit if the price of the share, how much it increases. So it has to increase, it has to be more than 505, then only you will have profit.
Yes.
Okay. Now we come to next here. Suppose a stock currently sells as rupees 48. A 1-year call option with a strike price of rupees 55 sells for rupees 9. And the 1-year risk-free rate is 6%. What is the price of 1-year put with a strike same price? So here we use the formula of that call and put parity. So the C0 plus, and they have not given here continuously compounded. So we use C0 divided by 1 plus RF. So this is 1-year P becomes 1 is equal to S0 plus P0. So all these values we can calculate. All these values are given and we can calculate P0. Is this okay?
Yeah, sir, it's clear. One thing,
Yes.
C means the price of call, P means the premium of put, and uh, we are uh, we are taking the present value of stock price.
S0 is the S. This S0 is the present. X is the excise rate.
Okay.
Okay. X. This is R. Okay. This is C0. Okay. And the strike rate is same. That's why this parity formula holds good.
Okay.
Okay.
Yeah.
Now,
So we always bring the exercise price to the present value to equate that.
yes, yes. Okay. Now we come to the underlying share is 500.
Suppose in this problem, if the strike price is not 55, other than 55, then we cannot use this formula.
Then we cannot use this formula. Okay. That the time duration and the strike price has to be same. Okay. A 1-year call option, 1-year call option, strike rate is same. Okay, before we go further, I will cover just some questions from the theoretical point of view, because there have been some questions in the PYQ on the same concept. So I will cover the relation between call premium and put premium with respect to stock price, with respect to exercise price, with respect to time, with respect to volatility, and with respect to time duration. Okay. So when stock price increases, call price increases. When exercise price increases, call price decreases. When time increases, call price increases. When volatility increases, call price increases. So we have covered everything. Stock, exercise price, time, time. Okay, I have covered. Is this okay? This one?
Yeah.
Okay. In the put, these two are opposite. So when stock price increases, your put price decreases. When exercise rate increases, your put price increases. With the volatility increases, put price increases. And with time, there is no relation. Okay. Okay. Now, certain other things I will cover. Now, there is a stock price of rupees 80. You have purchased a call for rupees 5 for a strike rate of 100. So what is the maximum profit you can incur, and what is the max loss which you can incur? Can somebody tell me? If I say max profit is unlimited, is it okay? And maximum loss is 5 rupees.
Can you
Yes.
repeat?
There is a stock which is at rupees 80. I purchase one call option for rupees 5. Strike rate is 100. And I'm asking what is the maximum profit and what is the maximum loss I can incur.
Yeah, maximum the stock price can go anywhere. That is why unlimited.
Okay. And maximum loss is how much?
Anything lower than 100, I will have only 5 rupees.
Only 5 rupees. So maximum loss I will incur 5 rupees. Okay. Now I give you the same scenario. This was for call. I give you the same for put. Stock price is 80. I purchase a put of rupees 5. A strike rate I get, so it is a strike rate is 100. So what is the maximum profit and what is the maximum loss?
Yeah, maximum loss is anything -5. And maximum profit will be capped at
No, it cannot be determined, is it?
20, right?
Maximum profit can be 100 only. The stock cannot go in negative. So stock can go only up to 0.
hmm.
So if it goes to 0, how much money I get? 100 rupees.
Okay. Mhm.
Okay, so my maximum profit is how much? Is the strike price. Okay, and maximum loss is -5. Whereas in call, my maximum profit is unlimited. It can go to anything. Okay, maximum loss is 5. So in both the scenarios, loss remains same, but the profit in call is unlimited. Whereas in put, maximum profit is always the exercise rate.
Yes.
Okay. So, yeah. So before going further, I wanted to cover this. Okay. Now, this we have seen. A stock is trading at 85 S0. The risk-free rate is RF. what is the lowest possible price for a 4-month European call option? So we had seen this formula. So the call price has always to be greater than equal to S0 minus X divided by 1 plus RFT. So here you see the RF is for 1 year. So your T will become, it is for 4 months. So T will become 1 by 3. So your C0 will be always greater than equal to 6.277. Okay. Now here in this question, if they give you the rate is continuously compounded, then use formula this X e minus RT. So this will become X into e to power minus RT. Is this okay? Yeah. Okay. Now I will increase the pace, otherwise we will get delayed. Already 1 or 10 minutes. Okay. Question number 4 is stock is trading at rupees 55. The annual risk-free rate is 5%. What is the lowest possible price for a 6-month European put option on the stock with a strike rate of rupees 60? So remember, for the put option, what you have to do, for put, you have to put the scenarios. So for example, first scenario is rupees 55 and the put price is, for example, X. You have sold, like, for example, one put. So your present portfolio is 55 plus X. Now for rupees 60, you don't have to pay anything because it has not gone. So your value becomes 60 after 1 year. So this now 60 you convert to the present value, which will become 1 plus RF 2T. And this, both the values you have to equate. So both the states, this will become equal. And by this, you can calculate the value of X again. Is this okay?
Okay.
Yes. Okay. Now, this is the question. Current price of a non-dividend paying stock is 75. Over the next 6 months, it is expected either rise to 90 or fall to 65. Assume risk-free rate is 0. Investor sells 6 months call options with a strike price of rupees 80. Which of the following hedges the position? Basically, we have to find the hedge here. So we have to calculate the hedge ratio. Hedge ratio from 10 minus 0 divided by 90 minus 65, which is 1 by 2.5. So for every call option, hedge 1 by 2.5 share, which is 0.4 share. So already I have explained this concept. Okay, now this question is from the same which I had explained earlier, how to find the call option price. So we have given stock trading at 50 in 6 months can either rise to 65, decrease to 40. Risk-free rate is 5%. A 6-month call option has an exercise rate of 55. What is the price of call option? So step 1 is find HR. So you have found the HR, you have found 0.4 share. Now to purchase this 0.4 share, how much you have to spend money? 50 into 0.4, 20. So your present portfolio is 20 minus C. Now you compare it with your scenario where you are not making anything. So in scenario 40, your value will become 40 into 0.4, which is 16. Now take the present value of the 16, which becomes 16 by 1.05, 1 by 2, because time duration is 6 months. And now equate this 15.61 is equal to 20 minus C and calculate C. Is this okay? This procedure? Jalaj?
Yeah, sir, it's clear.
Okay, good. Lower bound, again, the same question is there. We have to use the same formula. Then hedge ratio, again, they have asked the question hedge ratio, we can straight away calculate. Then this is a question where they have asked the risk neutral probability. So risk neutral probability is equal to 1 plus RF minus D divided by U minus D. So use this formula and you get risk neutrality. Okay. Then they have given with a standard deviation. So whenever the standard deviation is given, so you have to calculate U and D. So U is equal to e to power sigma delta T square root of, and D is equal to e to power minus sigma square root of delta T. Delta T is T by N. N is the N periods. So these are the N4. Time is 1 year. So you get delta T. Sigma is given 0.2. So you can calculate U and D. So they have calculated what are the up and down price multipliers. Okay. And then they have asked the same probability, the risk neutral probability. So risk neutral probability is e to power r delta t minus d divided by q minus d. Black Scholes se kya, I will not cover because they have told us that they will not be asking on this. So I'll not solve this full complex questions. Then these are basic questions from week 10 on the same formulas. So now with this, I have covered week 10 and week 11. Any question till now here in anybody's mind, I can cover that concept again. Anyone? Okay.
No, it's okay.
Now we come to week 12. So week 12 is basically about the risk and rewards. So in this, certain formulas are there. First of all is again the beta. So from if somebody has operated in the stock market, they know that every time if you do the analysis, so they give you the beta of that stock, and they also give an alpha of that stock. Now beta is nothing. Beta is the covariance of that stock price, the stock which is there. For example, I can call it as R of X, the return from that stock price, with the return from market, the entire market, and divided by variance of the market. This is the formula of beta. And where do we use this beta? I'll come to alpha later on. So this beta is used to calculate the expected return. So expected return of this stock will become RF plus beta into expected from the market minus RF. So this is the formula 1. This is formula 2. Now we come to alpha. So this is, we calculate this mathematically, but somebody says that no, I have an opinion that this, for example, here I have got this, for example, 15%. And alpha is nothing but opinionated return, expected return, minus this ERI is alpha, is equal to alpha. Now certain things from the understanding point of view, if beta is high, it means that stock has got more risk, or more risk, more reward. Okay, more risk and more reward. So that's why if you go to the stock market, we always cater for the stocks which have got small beta. And if alpha is high, it means good stock. So these are certain basics. Any question for this again? Anyone?
So what, how the alpha is calculated? What you have written?
Alpha is opinionated expected return. That we say that I think that it will earn 20%.
Oh, this is opinion, perception based.
Yes, yes. But this perception is also based on some things.
Okay.
Okay. So these are certain basics. Okay. So I will cover this again. So these formulas I have covered. So beta I have covered, ERI you have covered. Now from this formula ERI, if you calculate BI, so it will become ERI minus RF divided by ERI minus CAPM. And again from then the price of the stock. So price of the stock, we equate these two terms. So we know in our from earlier this, R is equal to Q minus P by P. And we say EERI is also equal to RF plus beta into expected RM minus RF. So if you open this, then you get Q minus P is equal to P RF plus beta ERM minus RF. Now you bring P this side, so this will become plus 1. And now you can have P is equal to Q over 1 plus RF plus beta into ERN minus RN. So you can be asked, okay, expect a question on this price also. Okay, so this is your sixth formula. Okay.
What is Q here?
Q here is your expected return.
Okay.
So in this we have covered. Okay, in the GSK, for the first question is about asking the beta. So calculate a beta. In this, they have given the correlation coefficient. So once the correlation coefficient is given, so your covariance of ABC and market will become correlation coefficient into standard deviation of ABC into standard deviation of market. So by using this, you calculate the covariance and put this covariance divided by into variance of the market. If the market returns a rate of 10%, then what will be the return of ABC? So straight away you have calculated beta. So beta you have got, and this is equal to beta is equal to delta. If it is given X, your return delta C by delta S. Okay. Then if there are two, you are making a portfolio, for example, one is A, one is B, the ratio is, for example, W1, W2, its beta is beta 1 and beta 2, and you have to calculate the beta for this combined portfolio, then it becomes beta is equal to summation of Wi into Bi. So this is your seventh formula. So these are the same questions, same formulas which are there. Now, there was also one question about the SML, which is the your security market line. So security market line is nothing, the formula which is there, this is the your security market line. And the slope of this market line is this ERM minus ERF. Okay. Now can we go to now PYQs straight away? There is only one.
Yes, yes.
Okay. So the question is the put call parity result for a non-dividend is given. So they have given it states that European put price plus the present value of the strike price must equal the European call price plus the stock price, which is wrong because as per the correct it is this is the formula. So just by going through this formula, you will come to know it is false. Then what is the delta of an option? So delta of an option has not been covered in the lectures, but the delta of an option is equal to delta of V, which is the delta change in the option price divided by delta into S. So this is known as delta. In the Black-Scholes pricing formula, stock prices are considered to be log normally distributed. So if we see the formula for D1, they have used this ln S0 by X, which is true. It is considered as log normally distributed. A call option is in the money when the stock price is higher than the strike price. So when it is in the money, when you make money, 110, 120. So this is the time when you are in the money. Otherwise, at the money means 110 and anything lower 110 out of the money. And in put, it happens opposite.
Lower means what did I say? At means at par, in means I am profiting, and lower
out of the money. Out.
Okay.
Liabilities of a commercial bank includes loans, deposits with other banks and the central bank and the various security. It is false because all these things are the assets. The part of the minimum variance frontier that lies above the global minimum variance portfolio is called the efficient frontier. This is true because this is your global. If we see the previous 1 hour week, I think week 6 or 7, this is the global minimum variance portfolio, and our minimum variance frontier is above this. So this is true. Then according to the CAPM, projects with higher beta requires a lower expected rate of return. So this is false because ERI is equal to RF plus beta into this premium. So ERI is directly proportional to beta. So if we need a higher beta, it will give a higher expected rate of return. When assets have perfect positive correlation, there are no benefits from diversification. This is true. This is from week 7 and week 8. That if we have to diversify, we have to diversify in such a way that they should be negatively correlated. That if one is going high, second is going low. Otherwise, if they are positively correlated, both will go down simultaneously. So there are, in case there is a perfect positive correlation, there are no benefits from diversification.
Sir, I have one question.
Yeah.
Sir, as we understand, beta is a market sensitivity.
Yes.
So it should be directly proportional that if the beta is high, we should expect higher return.
Yes.
How do we understand alpha?
Alpha is always good. Alpha means, okay, for example, that you have calculated ERI, for example, is equal to 15. Okay. But your other research, okay, this is calculated based on, okay, stock, okay, how much okay, stock has done performed. But there is some report, some financial analysis has come, and then they say, no, we expect this stock will have only 12% of growth. So now in this case, alpha is what? Alpha will be negative.
Yes.
So when alpha is negative, never purchase. And jitna alpha high hoga, itna hi the better the stock.
Oh, okay.
Okay. Then the yield curve, what is the yield curve? So the yield curve is basically the relation between the interest rate and the maturity. What will be the maturity amount? So that gives you the yield curve. So this is your interest rate, R, and what is your amount? So this is your yield curve. Then an investor can diversify the systematic risk. So systematic risk, if we go to week 1 and week 2, it was specifically covered that systematic risk, they cannot be diversified, they cannot be reduced, or they cannot be diversified. It is inside the system. This question is from quiz 2 kind of thing, easy question. Straight away the formula of compound interest you can find. Then they have asked a question on the Gordon growth model. Gordon growth model means that we can find the price of something of an asset by the formula by dividend divided by rate minus growth. How much a dividend he is paying, what is the risk-free rate, and what is the growth. So this will be the price. Gordon. And then the formula is the capital allocation line. So capital allocation line, the slope is given by ERP, which is the expected rate minus the risk-free rate divided by the standard deviation. So this is the cal line, and formula is this. Expected rate is equal to RF plus standard deviation into slope of cal. And this is the question again from the quiz 2. There are two risky assets that are negatively correlated with correlation coefficient is minus 0.5. Asset 1 has an expected return of 15%, standard deviation 10%. 2 has an expected return of 20% and a standard deviation of 12%. What are the weights of the assets in the minimum variance portfolio? Though there is a direct formula for this, you can use this. Weight formula is given by this. Weight 1 is equal to standard variance of 2 minus covariance of both divided by variance plus variance 2 minus 2 into covariance. But if you forget this formula also, we can directly calculate it, because the variance of the portfolio will be equal to variance of the first portfolio plus variance of the second portfolio plus 2 into covariance of sigma 1 of 1 and 2. And when you expand, you will get, then you take the derivative with respect to W1, you get equated to 0. and you get the value of W1. Is this okay? Otherwise, you can remember this formula also.
Yeah.
Okay. So I'll give you the small formula for this. So this is given by W1 is equal to sigma 2 square minus covariance of 1 and 2 divided by sigma 1 square plus sigma 2 square minus 2 into covariance of 1, 2. This formula also you can use. Jalaj, is this correct formula?
Yeah, sir, it's clear. And for W2, it is 1 minus W1.
W2 is straight. 1 minus W. Okay. Okay. This question is about finding NPVs. So we know the formula to calculate NPV. We can calculate this. Then this is the question from the week 9. A British pound buys 100 Russian rubles. Okay, so this is the question. Now we can understand like this. A British pound is purchasing 100 Russian rubles. The GDP deflator in Russia is 110. GDP deflator in UK is 105. What is the real Great Britain to ruble exchange rate? So just like India and USA, so here what has happened? Russia is here and Great Britain is here. Great Britain, this can purchase 100. So exchange rate has become 1 by 100 because they are asking real Great Britain to ruble exchange. So therefore, E will become Russia ka deflator, which is 110 divided by Great Britain deflator 105 into 1 by 100. Exchange rate will come. This is straight away from the formula 1 plus IT is equal to 1 plus IT star divided by delta E. And using delta E, we can calculate. They have asked only the expected rate of appreciation. So expected rate of appreciation is delta E. This is about the share price. Infosys 500 today. Trade investor buys 100 European call options on Infosys for ₹10. So he pays 1,000 rupees with a strike price of ₹490, and it goes to 495. So on each he will, how much he will get? He will get 100 into 500. So he will occur loss of 500. Which of the following describes a short option, short position? So remember, short position is always when you are selling something. Okay, you have sold. So a position where an option has been sold, that is known as short position. Consider a put option and a call option with the same strike price and time to maturity. Which of the following is true? So this is straight away from the parity formula, and you can see. And one will be in the money and one out of the money. The price of a stock is ₹84. A trader buys a put option. He buys an put option on the stock with a strike price of ₹80 when the option price is ₹10. When does the trader makes a profit? So trader will make the profit only when the price goes below 70. In rest all other scenarios, he will have loss. When volatility increases with all else remaining the same, which of the following is true? So I had covered that when the volatility increases, both call and put prices, they increase. When the strike price increases with all remaining the same, what happens? If the strike price is increasing, your call price decreases and put price increases. So this is what is the meaning of protective put? So protective put, okay, I will just cover it here. Protective put means that I have got 500 shares of Reliance. Okay. So protective put means that I have got 500 shares of Reliance. Now I buy 500 put options. Okay. Now, for example, this share is going at 500, and I feel that this share can decrease also. So at a strike rate of 450, I will purchase of 500 put options. So what happens that if my share has come to 400, so here my value becomes 400 into 500 is equal to this much, and here it becomes 400. So my share value, its value was 500 into 500 was 2,50,000. So to compensate for my loss, I will get 50 into 500 from here. So 25,000 I am earning. So it is like protecting a portfolio. I put a protective put. And इसका एक second वो है, second is known as covered call. In covered call, what I do, I sell call options. So basically it is to minimize my losses, both things. So these are the strategies. Okay. Then they have asked to what is the risk neutral probabilities straight away formula is there. You put again that Black-Scholes pricing formula for a call option. So I was telling you from here that they have given ND1 and ND2. If the stock price increases by ₹1, then what will be the change in the price of the option? So straight away we can see that C0 depends on ND1 minus ND2. So if stock price increases, so it depends on S0 here. So C0 by, if we take the derivative, we get ND1. So if the stock prices increases by 1, my C0 will increase only by the value of ND1, which is 0.6. Okay, I think, gentlemen, okay, with this I have finished. Okay, all important questions, concepts I have covered. In case anything is there, please post on WhatsApp or on the G Space. I will be able to answer all those queries. Can we call it off or any question? Yeah.
You have the WhatsApp group, means.
We have got one corporate finance. This is the group. Okay.
In the G Space I have, but in WhatsApp I don't.
Okay. So tell me your number.
In here itself.
Yeah, you can, if you don't mind.
Yeah.
Tell me. I will just add it.
So I just posted.
Okay, just hold on. Anybody else wants to get added?
And so you are forwarding this document in the G Space, right?
Yes. This document I will share it with all of you.
And recording is available in G Space itself?
Recording, once it will become available, it comes here maybe after half an hour, then I'll share with all of you.
In the G Space only?
In the G Space, in the WhatsApp, both I will share.
Okay.
Okay.
And so I just have one more small query. So do you have any reinforcement learning means things?
No. RL I don't have. RL I'll be taking next term. Okay.
RL you are taking next.
So this term I have got only DLP, I got corporate finance, and I got the algorithmic thinking in bioinformatics.
And this number, this WhatsApp number, are you adding me in the all the groups so that whatever